Well, hello everyone. The last video, you have made it. Been a long process, but here we are. And since it's a review, we are back outside. The one class tradition we had was outside for a review, and so here we are. And I'm outside as well. So let's jump right into it. And yep, see, we are outside. Chapter 14 quiz tonight at midnight. Same with your team member evaluation. Please get those in by midnight, and then it's just the final. That's it. So final exam, it's going to be up between 2 and 6, so start it at 2 to 3 because you've got 2 hours. And it's, as we've discussed, 110 questions. They're multiple choice, true, false, matching. That's it. No short answer, no essay. And then I will convert your grades to a 150 scale because that's how many points the final exam is worth. If you have questions on anything, you've got the original videos to look at. The slides are online, as you know. You have 2 review videos. The study guide is online, and you can email me. So any questions at all, plenty of resources. Happy to answer any questions. So with that, let's jump right into it. And chapter 12 was on accounting. Lots of numbers, all right? And so we started right with the definition of what is accounting. And it's just the process of measuring and summarizing business activities, all right? Interpreting financial information and communicating those results to management and other decision makers, okay? That's what it is. And then it was broken into management accounting, which goes to internal decision makers, and financial, which goes to both internal and external. From there, we talked a little bit about the big 4 in accounting, okay? And those are the big 4, KPMG, PwC, EY, and Deloitte. And they're called that because they do the overwhelming majority of big companies' financials. 497 of the S&P 500, as it says there. And then we talked about FASB and GAAP, talked about those together. Those are terms you're going to hear in the business world. FASB is the Financial Accounting Standards Board, and they evaluate and set GAAP in the U.S., GAAP being generally accepted accounting principles. So those are basically the rules and general guidelines for financial reporting. Many companies use them. It's required for public companies. But some smaller ones don't because it's expensive to have your financials done according to GAAP. But that's what GAAP is. Then we went right to financial statements and the concept of materiality. And we talked about the 4 main financial statements. And those are the balance sheet, the income statement, the statement of cash flows, and the statement of owner's equity. Those are the 4 main financial statements. And with the concept of materiality, that talked about what goes on the financial statements. So it really talks about relevance, whether an amount is large enough to disclose in financials. So that's materiality, relevance. Is that number large enough to go in there? From there, we started with the balance sheet. The balance sheet and the income statement are really the big 2, and we looked at some potential math questions and activities that you could face. So let's take a look at what the balance sheet is. It is based on the accounting equation. Assets equals liabilities plus stockholders' equity. It's called a balance sheet because those always have to balance. Okay? Assets have to equal liabilities and owner's equity. And there's a balance sheet, and you can see that. So assets here are 275, liabilities 125,000 plus 150,000 owner's equity equals 275,000. So it's a balance sheet and it balances. So from there, we did look at some math based on this. And here are some questions you could face. ABC has assets of $5 million, common stock of $1 million, retained earnings of $750,000. What are their liabilities? And all you're going to do is set up that equation. Assets equals liabilities plus owner's equity. Fill in the blanks. $5 million of assets. We know that retained earnings and common stock are both owner's equity, so they equal $1,750,000. Therefore, liabilities has to equal $3,250,000. Okay. Second question: if liabilities went up by $100,000 and stockholders' equity fell by $40,000, what would happen? Set it up the same way. That went up by $100,000. Owner's equity down by 40, so assets had to increase by 60, so they still balance. Then we looked at a couple of other examples that were similar. Let's say Jessica borrowed $25,000 from Eagle Bank. What does this mean to the accounting equation? Well, if she borrows it, it's a liability, right? That's a note payable. You owe that money. So that went up by $25,000. And what did you get from the bank? Gave you $25,000 in cash. That's an asset. So for this question, the answer is assets went up by $25,000 and liabilities went up by $25,000. No impact on owner's equity, right? Didn't touch that. And then our final question was this one. James owned a print shop and he bought a new printing press and paid cash $20,000. How does this impact it? Well, he paid cash, so $20,000 less in cash, and he got some equipment, right? He got a printing press. That is an asset, equipment. And so assets went up by $20,000 in equipment, and they fell by $20,000 in cash. There were no liabilities, right? There was no loans or anything that he owes, and it didn't impact owner's equity. So that's how you'd answer that question. So, just a couple of questions that you could get or face in business. From there, we moved on to the income statement and talked about accrual accounting. And with the income statement, it's just revenues, expenses, and therefore your profits or loss over a period of time. So it's different from the balance sheet. Balance sheet is what do we have and what do we owe. The income statement is how much did we make. So it's just your revenue minus expenses, and it's a bottom line is profit or a loss. Loss if expenses are more than revenues. And generally they're done through accrual accounting, and that recognizes revenues and expenses at the time they occur, which isn't necessarily when cash changes hands. That's accrual accounting, and the overwhelming number of businesses use accrual accounting. Gives you a much better picture of your financials, where you are. You can match revenues and expenses. So accrual accounting is really the standard in business that people use. From there, we talked about the bottom line. The bottom line, and that's part of the income statement. Because in an income statement, you have your revenue on the top, okay? Then you have your expenses below that, and then what's left over is net income, which is the bottom line. That's where that expression comes from, an income statement. So net income is the bottom line of an income statement, and that's what that expression refers to. From there, we looked at our third financial statement, which is our statement of owner's equity. And the statement of owner's equity simply talks about how owner's equity changes over a time period, right? And there's the equation right there. Retained earnings is just owner's equity for corporations. Okay, if you're a partnership, if you're a sole proprietorship, owner's equity is owner's equity. But for a corporation, you've got retained earnings, right? You can pay out something in dividends. You'll add net income to it. So it's referred to as retained earnings is actually part of owner's equity. And we used a math equation there as well to demonstrate that. So if you were given this question, that a corporation had retained earnings of $1 million, they had net income during the year of $500,000, and then paid out dividends of $200,000. Where are you at the end of the year with retained earnings? And it's simply setting up that equation, filling in the blanks, and you'd have 1.3 million retained earnings at the end of the year. And then finally, we looked at financing, investing, and operating activities, and those show up in the statement of cash flows, right? The statement of cash flows. Those are the three basic activities that businesses perform. Financing, that's the funds necessary to start or expand a business. You have to finance your business, get those funds to start or expand it. Investing, those are the long-term assets you need to require a business. Buying a plant, buying property, buying a big piece of equipment. Those are investing activities. That's different. And then finally, operating activities. Those are from day-to-day operations, just buying and selling your goods and services. And so a statement of cash flow is broken into those three activities: operating, investing, and financing. And then we spent quite a bit of time on ratio analysis. And that's just the comparison of various financial statement accounts, because it's a shortcut to help you evaluate the performance of a company. It allows you to do that without going through all the financial statements. And we talked about four main different types of financial ratios. Liquidity, which is your ability to pay off short-term debt, right? Your ability to convert assets into cash to pay off that short-term debt. Leverage, we know leverage just means debt. That's just your reliance on debt as opposed to equity. We talked briefly about activity ratios. We used the example of inventory turnover, so that's just a measure of management efficiency. And then finally, profitability. Obvious, right? Overall financial performance. The ability of your business to turn your activity into profits. So overall financial performance. Those are the four main financial ratios. And then as we got toward the end of the chapter, we talked about open book management, which is really just sharing information. We said it's a good idea to be transparent, and that typically companies that do this, it really leads to employee empowerment, and it can have a positive impact on quality. Okay? Employees will feel empowered, and therefore it can positively impact the quality of what they produce. So generally speaking, open book management is a good idea, and more companies are practicing this, are being more transparent. And then finally, public against management accounting. What's the difference? Well, public accountants are those who provide accounting services for a fee. So the big four, public accountants. Accounting firms, public accountants. And those are the three main services they provide: accounting and auditing of books, tax preparation and planning, and management consulting. The three main services they provide. If you work for a company, then you're a private management accountant. So you're not doing it for a fee. So if Montgomery College employs accountants, they're called private or management accountants. If a firm like Facebook employs an accountant, they're private or management accountants. They're not doing it for a fee for another company. They're doing it internally. And so that was really our look at Chapter 12. All those different concepts there. So from there we moved on to Chapter 13, which was managing financial resources. There's a reason there's money floating there. That was kind of the main topic of Chapter 13. And we started by talking about depository institutions. And we said commercial banks, savings banks, and credit unions are all depository institutions because you can deposit money there and you can write checks. The money can come out as soon as you write checks. We said that banks get most of their funds from depositors, right? People and businesses that deposit the money in the banks. And banks make money from the interest rate spread. They pay you and they pay businesses very little interest on their deposits, but then they loan that money out at higher interest rates, and that's where they make their money, on that spread there. And we said credit unions, some of you may belong to them. You have to be a member to belong to a credit union. Okay? Some companies like Marriott have their own credit union, but as long as you're a member, they offer services just like banks. Okay? But because they're not for profits, generally speaking, their fees are lower. Their fees are lower. FDIC, we said one of the good things about depository institutions, banks, and savings banks is the FDIC insures commercial and savings banks your checking accounts up to $250,000 each. So for checking accounts and savings accounts, up to $250,000 is insured by the FDIC. And then we went through the financial crisis of 2007, 2008. I talked a little about it and we showed a video. And this kind of summarizes it. It's a global crisis, but it started in the United States, and it was really started by the collapse of the housing market. There were a number of other reasons, but it was the collapse of the housing market in the United States, and then it spread globally. And it was the largest downturn we've had since the Great Depression. From there, we talked about the Federal Reserve. We revisited the Fed from our first chapter, chapter 1, where we talked about it. And we said the Federal Reserve, it's the central bank of the United States, it's the banker's bank, and virtually all large commercial banks belong to the Fed. But you don't have to, okay? Small credit unions, some savings bank, they don't belong. So it's not required, but virtually all large banks do belong to the Fed. And we said that the Fed has 3 main tools that it uses because the Fed takes care of monetary policy, right? We said before, fiscal policy, that's the purview of governments, federal, state, local governments, and that's taxes and spending. But the Fed, they take care of monetary policy, and those are their 3 main tools. Reserve requirements, telling banks how much they have to keep in reserve. For large banks, right now it's 10%. Open market operations, which is just buying and selling U.S. Treasuries, okay, and that helps to control the money supply. And then finally, the discount rate. That's the rate that the Fed charges member banks for short-term loans. So the discount rate is the rate Fed charges member banks for short-term loans. And banks may need this if their reserves fall below where they have to be. Then they have to borrow from the Fed. They then take that rate, mark it up, and pass that on to their customers. So, 3 main Fed policy tools. Then we started talking about securities, spent quite a bit of time on securities. And securities are also known as financial instruments. Same thing. And there's 3 main types: money market instruments, bonds, and stocks. And before we talked about each of those in turn, we said, you know, they are all traded on primary or secondary markets. And so we talked about the difference between a primary market and a secondary market. And simply, a primary market, think of Amazon. It's where governments and corporations issue securities and sell them to the public for the first time. Okay? They're issued for the first time, so the money goes in their pockets. Okay? After that, those same securities are traded on the secondary market. That's where you buy securities, on the secondary market. That's previously issued securities. And for that, you think eBay. eBay. As much as those trade, the money does not go back to the original group that issued them. That's the secondary market. And then we mentioned the term IPO, or initial public offering. And that's just when a company goes public for the first time. Literally, they initially offer stocks to the public for the first time. So that's called an IPO. An IPO. From there, we talked about each of the securities in turn, and we started with money market instruments, And we said CDs, Treasury bills, and commercial paper are all money market instruments, right? CDs issued by banks, Treasury bills issued by the U.S. government, okay? Just short-term securities issued by the U.S. Treasury. 30 days, 90 days, 180 days, 360 days, all short-term. And then finally, we said commercial paper, short-term securities issued by corporations, okay? These typically mature in from 1 to 270 days. They typically don't go longer than 270 days because then they have to be registered with the SEC and it's a big process. So typically 1 to 270 days are commercial paper. Again, they are short-term securities sold by corporations. From there, we took a look at bonds. These are also debt securities. Like money market instruments, they have to be paid back. It's debt. But bonds are typically longer term. And we said two factors typically determine the cost of a bond or the value of a bond, and that is risk and interest rate. Risk and interest rate. Okay, as long as you know what the risk is and you know what the interest rate is, you can understand the value of a bond. The interest rate is given right on the bond, and in terms of risk, well, bonds are rated, right? They are rated by the rating agencies. Either Standard & Poor's or Moody's or Fitch rates a bond, and that's typically the schedule they use. This is actually the S&P schedule. Moody's and Fitch is similar. And for S&P, a bond that's rated between AAA and BBB is called investment grade. Investment grade. If it's BB or below, it's called speculative or a junk bond. Sure, you've heard that term. So if it's rated low, BB or below, speculative or junk. And we asked, why would people buy a junk bond? And the simple answer is because it's a higher interest rate, right? They're less credit-worthy borrowers, so they have to pay a higher interest rate. And so people will think, I want that higher interest rate. I'm willing to take the chance that relatively few of these people will not pay the loan back, and so it's worth it for me to buy a junk bond because the interest rate is higher. And from there, we finished the chapter talking about stocks. And we said common stock is really what you buy. Preferred stock is relatively rare. You buy common stock, it's the basic form of corporate ownership. Companies issue stock to raise money. That's why they do it. And you buy stock for two reasons. One, because of price appreciation, right? Just means the value goes up. If you buy a stock for $10 and sell it for $20, you made $10. And a dividend. Most companies pay a dividend every quarter. That's just they look at how much they made, and they say we can take some of this and give it back to our owners. And that's what they do. They pay a cash dividend. So that's the reason why you buy stocks. And we said, where are stocks traded? Well, they are traded on exchanges. And the two biggest ones in the world are the New York Stock Exchange and the NASDAQ. NASDAQ is largely tech stocks. Apple and Facebook and Alphabet, which is Google, they all trade on the NASDAQ. But those are the two largest in the world. And then finally, we closed the chapter by looking at stock indexes. And we said the three best known in the U.S. are the Dow Jones, the S&P 500, and the NASDAQ Composite. The Dow Jones is literally 30 stocks, right? And we took a look at which 30 stocks they were. It was a good cross-section of companies in the U.S. The S&P 500, 500 stocks. Virtually every company you've heard of is probably in the S&P 500 if it's a public corporation. And then the NASDAQ is just, again, tech stocks. So if you hit stocks on your phone, those are the three indexes that will likely come up. Okay, and we said a stock market index is just a measurement of the value of a section of the stock market. And then we used an example in the video of the Intro to Business Sports Index and showed this is how it works, right? Each individual company is weighted depending on how big they are, and then you just look at what their stock prices are at the end of the day. That's how stock indexes work. And that wrapped up Chapter 13, right, on managing financial resources. That was what we went through, which brought us to our last chapter of the course, which was personal finances. Really a good way to end it, right? And there's a reason we have bulls and bears and credit cards and paper that got folded there, is we went through all of those. And we started with pay yourself first, right? That was the first thing we talked about. We said don't get this equation backwards, right? Disposable income, then pay yourself first, and what's left over is spending money. Don't reverse that, or you might not have too much to save. And we said you should start saving now, right? Start saving now because of the time value of money. Don't wait. Don't wait till you're into your 30s or 40s. You want to start saving now. Willpower. And then we talked about the time value of money and compound interest, didn't we? Quite a bit. The time value of money is simply the principle that $1 in the present is worth more than $1 in the future. And that's because you can invest it and it will grow. That's the time value of money. $1 in your pocket is worth more than $1 in a month or a year or 10 years because it will grow when you invest it. We said that inflation can erode the value of money over time, right? If things cost more and more and more, the money in your pocket is worth comparatively less. Recently, inflation has been very low, so that's been good news. We also talked about compound interest, right? Let me just go back because that's really here. And we said compound interest in this red line, that's how you're going to build wealth. Compound interest. It's really the most important concept for why you save and invest your money, because money does not grow if it's invested in a simple interest line. It grows like that, which is just interest on interest on interest on interest. It's not just principal. It's interest on interest on interest, and so it grows very quickly toward the end. That's why we had you fold a piece of paper, and we said 42 times if you folded a piece of paper in half, it would reach the moon. That, it shows the power of compound interest. From there, we talked about a budget. I think it's a good idea for you all to have a budget. A budget, of course, is just a document that itemizes your future income and expenses. So it looks at future income and expenses. And we said that you should consider using the 50-30-20 rule when determining how much to save. And the 50-30-20 rule just says 50% of your money should go to needs, expenses that you need to have. 30% can go to wants, things that you want. And then 20% should go to savings. It's just a rule of thumb. If you're looking for about how much should I be spending on these various things and savings, that's a good rule of thumb, the 50-30-20 rule. From there, we looked at the difference between savings and checking accounts, and most of you have both of these. So we went through savings accounts and checking accounts. And we said you should all have checking accounts. Savings really up to you. If it'll help you save and you want a slightly higher interest rate, great, fine to have them. Checking account, that will give you a debit card, right? And debit cards, the money comes immediately out of your account when you use them, right? That's what you use at ATMs. They're different from credit cards. And we talked quite a bit about credit cards, right? Credit card is similar to a line of credit, right? A line of credit. You have a credit limit, and you can't spend more than that. And we said you should pay them off every month, right? On time every month. That's critical. If you do that, you'll pay no interest. Okay, so pay them off on time every month. You'll pay no interest. You don't want to build up big outstanding balances. That could be a sign of a problem, right? If you're building up big outstanding balances. You don't want to do that. And then we looked at credit scores on credit cards and how they're calculated. And so we went through FICO scores. FICO stands for Fair Isaac Corporation, and we went through it. And again, we said the two biggest components are paying on time, right? And then paying everything. Paying on time and then paying everything. That's 2/3 of your credit score. At most, credit card or the FICO wants you to not carry over more than about 30% of your balance, right? So if you've got a $500 credit limit, you shouldn't carry over more than $150. That's 30%, okay? And if you want to get your credit report, that's where you should go. That is the best way to get a credit report, is to go to annualcreditreport.com. That's the website. And you get a free one every year, okay? That's required, that you can get a free one every year. That's where you should go to get it, to that website. And then we finished really our chapter talking about stocks and why people invest in stocks and why you should consider investing in stocks. And it's simply that over the long term, that's the important thing, over the long term, stocks have returned the highest returns, better than bonds, better than CDs, better than virtually anything. That's why people invest in them. And we showed you all sorts of graphs and tables that illustrated that concept. Okay? And we looked at 3 ways to invest in stocks that we would recommend: mutual funds, index funds, and ETFs. And we said the good news about these 3 is that they offer diversification. The cost is low. You can start many of these with no money, right? $0 to start or very low dollars to start, and you can open an account with no money for so many of these today. They're very convenient, right? You've got professional management. You've got people who are doing this on your behalf. You don't have to think about what stock should I buy, okay? So mutual funds, index funds, and ETFs are a good way to go. They're very similar. Mutual funds, okay, they're just a basket of securities. You send in money, other people send in money, and these funds pool all that money and just buy a basket of securities. Index funds, they are mutual funds, right? They're just a subset of mutual funds, but they track a specific market index, such as the S&P 500. And we said that's a great place to put your money. Warren Buffett would recommend it, many financial planners would recommend it, and I recommend it, okay? It's a good place to put money. And most of the big mutual funds are index funds. We showed you a table that illustrated that. And then an exchange-traded fund is essentially a mutual fund that trades on an exchange. If you're an international student and a non-U.S. resident, you cannot buy a mutual fund. Many companies won't sell them, but you can buy an ETF, which is essentially the same thing. It's a mutual fund that trades on an exchange. And we said some of the larger ones are, those are the initials they go by: SPY, VOO, and IVV. So just State Street, Vanguard, and iShares. We went through that. Then we closed by looking at retirement planning, specifically 401ks and IRAs. And we said a 401k, you get that through your employer, okay? You can contribute $19,500 a year, and there's all sorts of benefits to it, right? The employer matches, your contributions are pre-tax. It's very easy because it can be automatically deducted from payroll. The thing you have to keep in mind is you can't withdraw money without penalty. If you just take it out, there'll be a penalty because they're retirement accounts. The reason you get tax advantages is because the government wants you to save for retirement. So if you withdraw early, there's a penalty. You can borrow, but there's a lot of restrictions on that. It has to be paid back. You have to pay interest. You can only take a certain amount out. So that's something to keep in mind. But they're great vehicles. And then we ended by talking about IRAs. And IRAs are just individual retirement accounts. you don't need an employer for this. You can set this up the same way you set up your regular investment account, through Fidelity or Vanguard or any of the groups we showed you. You can set up an IRA. You can only invest $6,000 in an IRA, but many good things about them. Contributions are tax deductible if you're in a traditional IRA. Earnings grow tax deferred, helps you to save. But again, there's penalties for early withdrawal. Okay? Again, because the government wants you to save for retirement, that's why they're giving you tax breaks. So there's penalties for early withdrawal. We said many will do a traditional IRA because their tax rate is going to be lower at retirement. That's how it is for most people. But if you think your tax rate is going to be higher, then you can do a Roth IRA. Okay? And that way your contributions are made with after-tax money initially, so you pay tax initially, but when you take it out, you don't. So two different types of IRAs. And that was pretty much that, right? That was the chapters 12, 13, and 14. So I thought, well, we ended our class by being outside for our review for the midterm, so we'll end this also being outside in the same place. And I know what some of you are thinking. Well, technically that wasn't our last class, right? Because we actually had the midterm, and that was in the classroom. So for you people that are sticklers, there you go. All right? Look familiar? That was our classroom. And the last time you saw it was when you took the midterm, and I sure had hoped that we were going to be back in here, but, you know, what are you going to do? This wasn't how really any of us expected it to be. It's really a far cry from what I had hoped it would be and from what I'm sure many of you hoped it would be, but it was what it was, right? I think we had to just do the best that we could. And so with that, let me just say that I really did enjoy this class. I just wish I could have gotten to know you better. I wish we could have, you know, built more of a relationship, but it is what it is. So again, if you have questions on any of this, plenty of resources out there for you, all the original videos. All the slides are online. You have the 2 review videos, the study guides, and you can email me. I'm happy to take any questions. So with that, good luck on the final exam on Monday, and it's been fun, and stay healthy and take care of yourselves.